Hi, everyone, this is the Encyclopedia Channel. The book that this program interprets for you is The Biography of Graham, the Godfather of Wall Street. Benjamin Graham is a securities analyst, financial educator, and he is also the spiritual mentor of Warren Buffett. Graham is known as the Godfather of Wall Street, not because of how many financial institutions his family controls on Wall Street, nor does it mean that he made the most money on Wall Street, but because of his contribution and influence on the investment field. In addition to Buffett, Graham's investment thinking has also influenced a large number of top investors and several generations of Wall Street fund managers, so he will be called the Godfather of Wall Street. So, what did Graham go through early on that shaped his all-important character? What is his investment philosophy? What are margin of safety, Mr. Market Doctor? After listening to this episode, you will understand. In 1934, Graham published Security Analysis. Before this book, security analysis was not considered an industry in the United States. People would buy and sell stocks based on inside information and market trends. And the value investment ideas he put forward in the book help people make buying and selling decisions based on the company's intrinsic value. Value investing is investing based on the true value of a company. The New York Association of Securities Analysts once commented on Graham, "The investment industry used to be like a dark labyrinth." It was Graham who drew a map for the first time. Since then, investors have found a bright way out of the dark labyrinth. Therefore, people often call Graham the father of fundamental analysis and the father of securities analysis. Some may be hearing Graham's name for the first time. It doesn't matter, as long as you have understood Buffett's investment philosophy before, or heard of value investing, then you are no stranger to Graham's investment thinking. For Buffett, Graham is not only the investment mentor who changed his life, but also the existence second only to his father. He once said that if he hadn't been exposed to The Intelligent Investor written by Graham, his life would definitely be very different, and his net worth might be several zeros less. The book interpreted this time is Graham's memoir, in which he recorded his experiences in the first few decades of his life. Investors must be very clear that the most basic characteristics of a value investor are patience, self-discipline, and risk aversion. This book can help you further understand how Graham's investment ideas came into being, and why he created the school of value investing instead of others. This book allows us to see how an extremely smart person became a master in the investment field through self-study, and how he changed the investment industry and the investment thinking of future generations through his own writing. Graham did not mention his later life in the book, so in this interpretation, we will also add the biography, An Intelligent Investor, written by others for him, as well as his main investment philosophy, to help everyone better understand this Wall Street godfather. This book is divided into 3 parts. In the first part, we learn about Graham's 2 important characteristics through his early experience: extremely conservative and extremely intelligent. In the second and third parts, we will use the 3 roles of value detective, Mr. Market and Market Doctor to understand Graham's main experience on Wall Street and his 3 important investment concepts: margin of safety, Mr. Market, and buying stocks is buying companies. At the end, we will also introduce Graham's transformation in his later years. First part. We get to meet a Graham who is deeply reserved and very smart. What is described as extremely conservative is not Graham's view of feelings, but his view of money. His special family background and experience made him very sensitive to money since he was a child. In 1894, Graham was born in London, England. He was the youngest child in the family, and he had 2 older brothers. Graham's father was a businessman who imported china and bric-a-brac. He wanted to establish a branch in the United States, so he moved to the United States with his whole family. At that time, Graham was less than 1 year old. The family lived well enough, with a French housekeeper, cook, and frequent excursions. My mother loved shopping, and Graham often went to department stores with her when he was a child. However, when he was 8.5 years old, major changes took place in his family, and his father died of illness. Families that were originally rich gradually slipped into poverty. The business left by his father had to be abandoned due to poor management. The assets originally owned have been disposed of and pawned one by one, and there are not many left. My mother pinned her hopes on the stock market and invested in the stocks of U.S. Steel Corporation, but these assets were wiped out during the financial crisis. Graham was originally a naive and sensitive child. After his father passed away, he became an independent and responsible little adult. Before he was 9, he started doing odd jobs selling newspapers. At the age of 12, he knew how to make a little money in various ways to avoid financial embarrassment. At that time, he understood everything can only be done by himself, and he must focus on doing what must be done. He held various part-time jobs, tutoring math, delivering milk, working on farms and theaters, and assembling telephones. These part-time jobs stayed with him after his father passed away. Even while working on Wall Street and earning a decent salary, Graham was still making extra money by tutoring people. The transition from affluence to poverty had a profound effect on Graham's state of mind. Deep down in his heart, he yearns for a rich spiritual life, but the hardships of life force him to focus on material life. For a child from a rich family, money may be just a number, and its function is abstract, but for Graham Jr. money has a real and concrete power, and it is a survival tool that he must use a lot of labor for. Graham was very sensitive to money. He once stuffed all the pennies into a chocolate bar box. He would often count the coins to see how much wealth he had accumulated. He came to worship money, and for a long time he believed that the main sign of success was making a lot of money and spending a lot of it. The early difficult experience made Graham form an extremely conservative view of money, but when he entered Wall Street, this view of money became a huge advantage. He was always picking stocks and bonds that were more cost-effective. He always emphasized the safety of principle and advised people to avoid financial risks. He once said this sentence: "There are two principles in investment. The first principle is not to lose money, and the second principle is not to forget the first principle." Another quality of Graham is that he is extremely intelligent. Tell a few things about his school days, and you will know how smart this originator of securities analysis is. The first little thing happened when he was almost 10 years old. He came to a new class, full of boys, and they started laughing when they saw that Graham was still dressed like a child, because they were all older than Graham, and they all had suits on. The reason for this is that although Graham was younger than them, he skipped 4 grades in school because of his excellent grades. The second little thing can reflect how superior Graham's memory is. Graham, aged, went to the doctor one day because of vision problems. The ophthalmologist asked him to read a line of writing, which would gradually change from large to small. After reading a few words, Graham asked the doctor, "Is this a sentence in the autobiography of Benjamin Franklin?" The doctor was very surprised, and it was the first time he met a patient who could recognize this sentence. Graham also proudly said that he could recognize it because he read the autobiography of Benjamin Franklin when he was in elementary school more than 60 years ago. The third little thing was when he was about to graduate from Columbia University. Graham also received job offers from the English, philosophy, and mathematics departments of the university. The teachers of the 3 departments all took a fancy to him, which shows that Graham not only has good grades, but also has a great learning span. A lifelong learner, he was interested in learning from an early age and made learning a part of his life. Take him as an example when he was studying at Columbia University. He majored in mathematics and took many mathematics-related courses. At the same time, he was also an associate expert in German literature and had good grades in Latin. In addition, he was interested in philosophy and history. You will be even more surprised if you know the circumstances under which he completed so much schoolwork. Graham was a very disciplined person with high self-esteem and high demands on himself. When he came to Columbia University, he set the goal for himself to graduate with enough credits in 3 years, but in fact, he achieved it in only 2.5 years. Moreover, in the past 2.5 years, he is still doing a lot of part-time jobs to earn his own living expenses. During his freshman year, he worked nearly 40 hours a week at the movie theater, which was almost a full-time job. It was under such circumstances that Graham graduated early and was inducted into Phi Beta Kappa. These performances are enough to prove that he is an extremely intelligent and self-disciplined person. In 1914, when Graham was just 20 years old, 3 Columbia University departments offered him an olive branch, but he turned them all down. This extremely conservative and extremely smart young man is going to Wall Street to work in the financial industry. The second part. Next, we began to understand Graham's experience on Wall Street and his investment philosophy. He has worked on Wall Street for more than 40 years. He started as an errand boy, sold bonds, worked as a partner of a large investment fund, started a business, and had his own investment company. In the value investment philosophy he expounded, there are three basic concepts, namely margin of safety, Mr. Market, and buying stocks is buying companies. In this part, we first use the role of value detective to learn about Graham's first job and his margin of safety law. After graduating from college, on the recommendation of the school's dean, Graham entered a financial company called Newburgh Henderson Loeb. Because he has no professional training in economics, he can only start as an errand boy and assistant and understand this business from the beginning. 4 weeks later, Graham came to the bond department as a salesman. He set himself the task of learning as much as possible about the bond industry and contributing as much as possible to the bond sector. He began to read a large number of relevant textbooks, one of which was called Bond Investment Principles. When he was studying hard, he would never have imagined that he would write a textbook to replace the one in his hand. Graham quickly became acquainted with financial literacy. He wanted to write a report analyzing the state of the Missouri Pacific Railroad Company, because he had read the company's fiscal year report and found that their operations and financial conditions were in a dangerous state, and investors should no longer hold its bonds. He is like a value detective, who can judge the true financial status and intrinsic value of a company by digging out important information buried in financial reports, and find out companies with poor financial status. After writing this report, Graham realized that he wanted to be a securities analyst more than a bond salesman. Due to his accurate judgment and excellent analytical ability, he got his wish and transformed into a securities analyst. As a wild securities analyst, Graham worked differently from others. At that time, Wall Street was full of speculative atmosphere, and stocks were like gambling chips. Those experienced people on Wall Street believe that the rise and fall of stock prices are caused by a series of human factors, and the big dealers have the ability to manipulate the price of every popular stock. In their view, when analyzing stocks, we should focus on the actions and plans of these market makers. When these people analyze stocks, they also study some data related to business operations and profit forecasts, but in Graham's view, these are superficial analyses rather than professional research and analysis. He found that in the field of stock analysis, a large amount of financial information is seriously wasted. Around 1914, the financial situation of large industrial enterprises continued to improve. Some listed companies began to provide their own detailed operational and financial information. Various regulatory agencies were also collecting data from railway, natural gas, and electric power companies for free query and collection. When people analyze stocks, they begin to focus on the company's intrinsic value and investment advantages. These are new trends in the financial field. Graham knows the value of public financial information and can distinguish the importance of such information, what is reliable and what is not. At that time, Wall Street was like an experimental field for him, where he could fully display his skills and prove his ability. Opportunities presented themselves quickly. In 1915, the Guggenheim Exploring Company was about to be spun off, and the company also held stakes in several large copper mining companies that were hot stocks on the stock market. Graham calculated that the combined equity value of these outside companies was greater than the total market value of Guggenheim Exploration itself. Therefore, he devised a set of operation plans: buy the stocks of Guggenheim Exploration Company and short the stocks of several other companies at the same time, so as to achieve deterministic arbitrage income. Graham also estimated the possible risks in the arbitrage process, but he thought that these risks were not too big, so he recommended this arbitrage plan to the company and other colleagues. The spin-off plan of the Guggenheim Exploration Company went smoothly, and Graham's arbitrage operation also achieved good returns. Everyone was very happy after making money, and the profits they obtained were as accurate as Graham's calculations. This small trial made Graham start to have a strong interest in those undervalued stocks. He concluded that investors can make more or less money by buying undervalued stocks. He also made an inference: if the market price of a stock is significantly lower than the intrinsic value of the company to which it belongs, then its price should have a huge room for growth. On the basis of this conclusion, Graham later proposed a very important investment concept, margin of safety. In The Intelligent Investor, Chapter 20 is titled Margin of Safety as the central idea of investing. The margin of safety refers to the difference between the intrinsic value of a company's stock and the current market price of the stock. In the stock market, even the most profitable and stable companies need a certain degree of price buffer to resist market fluctuations. The margin of safety is this price buffer. Expressed in a formula, the margin of safety is equal to the intrinsic value minus the market price. In more common terms, the margin of safety is to calculate how much something is worth, and then buy it at a relatively low price, which is equivalent to buying $1 for 5 cents. The price of a stock is determined by the market, and the intrinsic value of a company's stock is judged by analysts. That is to say, the key to making money through the margin of safety law is how to estimate the intrinsic value of a stock relatively accurately, and how to find something that is worth $1 but only sells for 5 cents now. This kind of calculation is what Graham is best at. Being extremely conservative, he always chooses companies with stable operations, strong capital, and relatively low debt. After just a few years at Newberg Henderson Laub, Graham's first full-time job, he became a partner managing the firm's proprietary accounts and a tax specialist serving a variety of clients. His work brought a lot of commission income to the company and also laid the foundation for him to start a business. In 1923, Graham resigned and founded Graham & Company, managing account earnings for the Harris brothers, owners of the Harris Raincoat Company. However, this business partnership was not very pleasant. It only lasted for more than 2 years, and both parties wanted to go it alone. In 1926, Graham transferred the funds of himself and his clients to a joint account named after him. The Benjamin Graham joint account started with a principal of $400,000 and 3 years later had assets of about $2.5 million. The third part. Next, we continue to understand Graham's other 2 important investment ideas through the 2 roles of Mr. Market and Dr. Market. Mr. Market is not a character played by Graham, but a fictional character in his book The Intelligent Investor. Graham likes literature, and he also likes to use anthropomorphic metaphors to summarize market behavior when writing. Mr. Market refers to the emotional nature of the stock market. Graham has a very famous statement in The Intelligent Investor. Suppose you have $1,000 of shares in an unlisted company, and you have a partner named Mr. Market. He is enthusiastic and comes to you every day. Mr. Market will tell you based on his own judgment how much the equity in your hand is worth today, and he also hopes that you will either sell your own shares to him or buy some more shares from him on the basis of this price. After you have been in touch with Mr. Market for a long time, you will find that the prices he estimates are sometimes quite reliable and are more in line with the company's development status and prospects. But more often than not, his prices look stupid, either too high or too low. Until now, some people are citing Graham's statement to illustrate the vagaries of market behavior. So, what should we do about Mr. Market? Graham continues the conversation with us throughout the book. He said, if you are a very cautious and sensitive person, will you decide the value of the $1,000 you own based on the information provided by Mr. Market every day? You will be willing to sell him when he offers a high price, and buy more shares from him when he offers a low price. He believes that for real investors, price fluctuations have only one important meaning, which is to have the opportunity to buy after the price has fallen sharply. The rest of the time, investors are better off forgetting about the stock market and focusing more on their own dividend returns and the operating results of their businesses. In other words, take advantage of the market or leave it alone. Most people's investment behavior will be swayed by Mr. Market, but Graham is clearly aware of the existence of Mr. Market and proposes ways to get along with him, which is related to his experience on Wall Street. He learned early on the power of emotions. When Graham started working in 1914, when the First World War broke out in August of that year, hostility and tension flooded the stock market, and a large number of stocks were sold off. Although people knew that the outbreak of war would bring wartime economic prosperity, they let their instincts dictate their actions. Graham, who has seen panic sell-offs and unbelievable surges in his career, discovered that the real risk is not in stocks but in people themselves. In the late 1920s, the U.S. stock market rose to incredible heights. People were flocking to borrow money to buy stocks, and the speculative atmosphere was unprecedentedly high. Under such circumstances, even some respected financial institutions and investment bankers have begun to carry out some dangerous operations. In September 1929, the U.S. stock market plummeted, and in October, panic selling on Wall Street reached its climax. The stock market crash triggered the Great Depression. The book An Intelligent Investor introduces some specific situations. From 1929 to 1933, the total personal income of the United States changed from nearly $86 billion to $47 billion. The foreign trade volume fell from $7 billion to $2.4 billion. This period was also the worst period of Graham's fund management career. It can be said that Mr. Market is a fictional character created by Graham, but it is also a valuable reminder that he exchanged real money, experience, and lessons. In the book An Intelligent Investor, I also saw an anthropomorphic metaphor, that is, market doctor, which refers to the value investor represented by Graham. If Mr. Market is a patient with extremely polarized personality, occasionally calm and often manic, then a rigorous value investor is like a market doctor. No matter how emotional Mr. Market is, the market doctor will insist on rationality, start from the data, write his own diagnostic report, and evaluate the intrinsic value of the company, just like Graham. We know that the job of a doctor is not only to diagnose the disease, but also to treat the patient. For investors, the way to treat patients is to treat investment as a business, and even persuade the company's management to change policies when necessary. This approach is not at all uncommon now, but in 1926, when Graham, as a shareholder, tried to persuade the management of the Northern Pipeline Company to do the right thing, the old men on Wall Street thought he was crazy. Because back then, the standard Wall Street practice was if you don't like management, or what they're doing, sell your stock. Nobody wasted their time trying to change a company's internal policy from the outside. Not only did Graham do it, he did it. At that time, the American Standard Oil Pipeline Company was required to split up due to monopoly issues. After the split, there were 8 small-scale pipeline operators, but very little data related to them was disclosed. Graham, the value detective, went to check the financial report and found a treasure. One of the pipeline operators was Northern Pipeline Company. After calculation, Graham found that the company's stock price was $65, but each share implied cash assets of $95. So he continued to buy shares of Northern Pipeline Company and became one of the major shareholders. The stock price of Northern Pipeline is undervalued because they have few profits and many assets that can be realized, but they are unwilling to distribute them to shareholders. He persuaded the executives of the other party to distribute a large amount of assets that do not affect the business operation to investors, so that the full value of the company can be reflected and the market's expectations for the Northern Pipeline Company can be raised. Graham's proposal was initially rejected by the other party, but he was not discouraged, bought more stocks, increased his shareholding ratio, and became a director of the company. Eventually, the company adopted a plan similar to his, distributing assets to shareholders. Under this plan, the total value of New Northern Pipeline stock, plus cash rebates, ultimately exceeded $110 per share. Why is Graham so persistent? Because in his view, buying stocks is buying part of the company. Beginning in 1934, he argued in his articles that shareholders should have a more sensible and positive attitude toward corporate management. Be generous to those who perform well, and be suspicious and question those who perform poorly. He also wrote this sentence: the highest level of investment is to treat it as a business. His intention is not to occupy the magpie's nest and let investors participate in management, but to force investors to pay more attention to the company's profit and loss statement and balance sheet, rather than just looking at short-term stock price fluctuations. After understanding the 3 investment concepts of margin of safety, Mr. Market and buying stocks is buying companies. Let's go back to Graham's life trajectory. In 1929, Benjamin Graham's joint account had $2.5 million in assets, but as the stock market crashed, the account assets continued to shrink. In 1932, the account suffered a cumulative loss of 70%. The stock market crash severely affected Graham's personal income. While trying to find ways to adjust the investment portfolio, make up for losses, and recover gains, he regained the habit of frugality and cut living expenses on the other hand. He was convinced that the key to material happiness was the pursuit of a modest standard of living in virtually all economic conditions. Although these years were difficult, fortunately, he also started his academic career. In addition to teaching securities analysis at Columbia University, he also wrote a large number of articles and works, and it was these courses and works that established his reputation as the Godfather of Wall Street. Finally, let's take a brief look at Graham's later years. Graham's retrospective in this book is only written around 1940, and he died in 1976. During this period, what happened to his life? His career remains diverse. His joint account became Graham Newman and Company, which operated until his retirement in 1956. From 1936 to 1956, Graham Newman's average annual rate of return was approximately 17.5%, beating the performance of the broader market by 14.3%. He controlled Geico and brought it public, and was a director of P&R, owner of coal and railroad assets. After securities analysis, he successively published works such as Reserve and Stability and Smart Investor. He was still working on literature, writing his own plays. While his career is fruitful, he is also constantly facing losses. He lost 2 sons and his mother was killed by robbers. In the last few years of his life, he suffered from kidney disease and hypertensive heart disease, and faced health problems. He was suffering physically and mentally, but in his later years, he changed his attitude towards life. As a young man, he felt pessimistic about his life, feeling that his world was full of mistakes, disasters, and disappointments. But at the age of 80, he became optimistic and felt that his life was extremely successful and happy. Some people may attribute this change in life attitude to wealth, and it is the material life that brings Graham a sense of satisfaction. But Graham said that at least half of all the happiness he enjoyed in his life came from the spiritual world, from beautiful things in culture, especially literature and art. On his 80th birthday, he also appealed to his descendants in his speech to strive to enrich their spiritual world. Once you enjoy the fun of spiritual life, don't let it slip away. An investment master who deals with money every day, in the first half of his life, he mainly pursues money, but in the last period, he advises future generations to enrich their spiritual world and not say a word related to money. I don't know what kind of emotion you will have after listening to this. After watching Graham's 80th birthday speech, I thought of a sentence from the German philosopher Simmel: money is only a bridge to ultimate value, and people cannot live on bridges. This is the end of this episode of the show. What do you think about it differently? Welcome to leave a message to discuss with everyone. Hey, if you like our channel, please subscribe us. Haha, remember to like it.